My name is William Cain, the company's editor at Shares magazine. Delighted to have the opportunity to share with you a few of the things that I've been seeing in the markets over the last few months, and also my colleagues, what we've been talking about in the market, and also what are the potential outcomes for the remainder of this year and also beyond. So what I'm going to look at really over the next kind of 15 or 20 minutes is not this disclaimer, but that is the disclaimer if you want to have a look at it. These are the kind of four key areas I'm going to be having a look at in the next few minutes. First of all, the key driver of stock returns clearly is the underlying performance of the businesses. So what has the performance been like in the first quarter of 2016? Obviously, we're now in May. Most of those results have come through. So we've got a good insight into how companies have kicked off so far and how that looks going into the end of this half and into the back end of 2016. Secondly, going to have a look at the general economic outlook, how that informs the position that these businesses are in, how it's affecting different sectors, and what to look out for over the coming months. And also, what I'm also going to go over is how we kind of try and track the quality and the value of coverage which we give to our readers via our picks for 2016, which we assemble at the start of the year. These are our best ideas at the start of 2016 and the stocks that we think are going to potentially perform well over the course of the year. So first of all, I just wondered if we could start with a bit of a quiz, or if somebody wants to venture or hazard a guess at what you might think the overall revenue growth across the whole of European publicly listed businesses might have been in that first quarter. If anybody wants to put their hands up and have a guess, I have to say that it was okay. Yes, sir.
Under 1%.
Okay. Right. Would anybody go above 0%? 10%. Up 10%. Okay. And who would kind of go kind of lower than 0? I can see a few nodding heads there, and lower than 0 would have been absolutely right. It was a number which actually surprised me a little bit as well when I saw them. This is across Europe, all stocks excluding financials, which don't really have revenue. They have interest income, they have fees, but it's not already revenue. And these are all of the sectors. So the overall revenue performance for European stocks was minus 6% in the first quarter of the year. Now clearly, you can see that part of the reason for that is right down there at the bottom, which is energy, with very low oil prices and commodity prices generally. If you are producing the same amount of oil or the same amount of commodities in the first quarter of this year as you produced in the first quarter of 2015, and the price is halved, then your revenue is also halved. And so that's been a really big drag on performance in the first quarter, and it's also was a drag through 2015 as well. What you can also see, though, is the winners and losers, and you can get an idea of why sales performance declined, and you can also see what it means for your investments as well. So up at the top, information technology. You'd expect technology stocks to be doing very well. They're typically growth stocks. If you'd gone back, say, 15 years in 2000 and you said technologies stocks were growing at double-digit rates, it probably wouldn't really have mattered because they weren't very profitable anyway. At the moment, technology stocks are actually some of the most profitable stocks on the market. So we've got a very different environment now in technology, and that's clearly been driving growth, sales growth in Europe. We've also got healthcare up at the top. Now, obviously, some of Britain's most respected investors have been very aggressively taking positions in healthcare stocks, and you can see exactly why here. That's a 2.7 sector-wide growth. It's clearly outperformed the market, and that's the reason these investors own these stocks, because they are robust performers even when the general market is struggling. And then the third line you've got there, consumer discretionary. I think this is quite important as well. because one of the big debates around the back end of 2014, 2015, when the oil price went through the floor, was whether this could actually be good for the economy via consumer spending, via the impact and the benefit which it would give to disposable incomes. And you can see a little bit of that coming through there. There's it's modest growth, but what you obviously get when you get a small percentage increase in consumer incomes across in the United Kingdom and a lot of oil importing countries across Europe, it really is it's a boost to consumer spending, and incrementally, because it's across a wide base of people, it has a big impact. And so there's a little bit of growth there in consumers' discretionary, obviously spread quite widely. We've got telcos as well, which have done reasonably well in that first period, which is typically very stable performers. And then going down through, you can see kind of consumer staples, industrials, materials are the ones kind of picking up the slack down at the bottom. So if we move on now, we've got the similar numbers for the US market. I think one of the surprising things is the US actually posted stronger growth than the European market, given the strength of the dollar so far, through 2015 and into the first quarter of 2016. It clearly has a deflationary impact on the economy and on sales. So it's actually a really solid performance, particularly when you consider that a lot of the S&P 500 stocks earn their money outside of the US. Some of the bigger companies, Apple, IBM, and companies like Google as well, they're earning money abroad. They're bringing it back to the US at a worse exchange rate, but they're actually still posting relatively solid revenue numbers. And what you can also see, I think, here is there's a very similar story to Europe. So in terms of the sectors, in terms of the performance across those, what you can see is that you've got healthcare up there, you've got a little bit stronger consumer discretionary spending, and down there at the bottom, much the same, energy stocks struggling. I think one of the other interesting things you can take out of this, certainly over the last couple of months, is if you actually flip that those sectors upside down, they've actually been the better performers. So you look at energy stocks, for example, and really what we're starting to see, and what you saw at the start of what you saw as you went through the results season, was that actually people have become much too bearish about the outlook for energy companies. And even though the sales are down, more than a quarter there, what we've actually seen is that people have come back in on the prospects of a little bit better performance in the second half of this year. But clearly, if the stock market is going to get a little bit better over the course of the year, those sales numbers have got to improve a little bit. As we move into the second half of the year, the commodity prices and oil prices start to run up against much easier comparisons. So, with oil around $50 a barrel, it was roughly $50 a barrel in the second half of 2015. So I think there's a potential for the headwinds which have really been holding back stock market performance so far this year and in the back end of 2015 to potentially fade away. Obviously, it depends on commodity prices stabilizing, but it obviously makes it a lot easier for energy companies and the companies which service them as well, because obviously you see there in industrials negative growth. Part of the reason for that is because they're supplying services into commodity-related businesses. So on the economy and the general economic outlook, I think this is quite a useful way of kind of considering the sustainability of growth, and it also gives you a few clues into some of the things that we've seen happening, which have informed policy in recent months. A little while ago, a couple of weeks ago, the United States published a list of published a list of countries, and it put them on a watch list, essentially, saying that it was concerned about their currency policies, or that it was watching what their currency policies were. And there were familiar countries that you would expect. So China, has been accused of having a weak currency for some time. Japan has also weakened the yen fairly dramatically in recent years. One of the surprise names on there was Germany. And I think if you look at these numbers, you can get an idea of why that might be. Germany's got a current account surplus of close to 9% of GDP. And that's pushing the euro area into a stronger trade position than even China, which is quite a remarkable fact. And clearly, part of the reason for that is because of the Eurozone difficulties that we've seen in Greece, the need to get the currency to a level where the peripheral countries are able to stand on their own 2 feet. But at the same time, if the currency is at the right level for Greece and Spain and Italy and Portugal, it's much too weak for what is an incredibly strong German economy. You can see that 9% number reflects the strength of the export business, which essentially a weak currency brings relative to their competitiveness. So that's part of the reason I think that the US has made that statement. And what we've also seen in the last couple of weeks, a G7 meeting with finance ministers in Japan. There's also a meeting ongoing with heads of state. And what the push has been is to implement a form of a concerted global fiscal stimulus. And part of the reason for that is very clear from those numbers. China, Japan, and Germany have got very strong current account surpluses relative to the rest of the world. And you compare that with, say, the United States and Britain, which you can see there has one of the worst. There needs to be a stimulation of general global demand, essentially, to reverse some of those trade imbalances and essentially bring the deficit countries a little bit more towards a normal situation, and also to reduce some of those very large external surpluses which are being generated elsewhere. And if those kinds of policies are implemented, it's very good for equities potentially, and it also possibly kind of neutralises some of the big imbalances that we've seen over the course of the year, which has led to a lot of kind of investor uncertainty, particularly the back half of 2015 when when there was a lot of concern around China's currency. So these were some of the calls that we made at the start of the year. What we're really trying to do is, back in December, we're trying to look at, what was the market going to do over the course of 2016, and where did you want to be positioned? And I think what we took the view was that towards the back end of this year, we were going to start seeing some of the supply chain pressure coming off the commodities, off the kind of businesses which serve commodity industries and oil and gas. So you can see up there, that's played out reasonably well. I mean, Agreco actually has had a very good first quarter update, and it is obviously going into this period now where potentially you can see that if commodity prices hold, some of the concern about its ability to maintain contracts may start to fade away. We've also got Breeden up there. Breeden we had in 2015 as well. It delivered, I think, 20 or 30% in 2015, and it's up again in 2016. It's really a play on kind of general infrastructure. And overall, you can see at the bottom, first 5 months of the year, on aggregate, those stocks have beaten the market by around close to 3%, and that's just for 5 months. So, I mean, if they were to continue that performance for the remainder of the year, you'd be looking in the region of 6%. And if we ended the year 6% ahead of the all share with our key picks. I think we'd be very happy with that. Last year, I think if you looked across all of the publications that make these kind of give these ideas at the start of the year, 2015 was a much easier year to be ahead of the market, because as long as you didn't have too much in the commodity area, you're going to beat the market. It was quite simple. And you also saw that for a lot of active fund managers, it was a great year. So, Neil Woodford beat the market by 15% in 2015. A lot of the equity income funds did exceptionally well, but that's reversed in 2016, because actually the commodity stocks have actually started to outperform a little bit, particularly since February, and that's really just an index environment. The FTSE indices are very heavily loaded up with oil and gas and resources stocks. So if you don't have a big weighting towards those in your portfolio, then you're going to struggle. And typically, equity income funds are not heavily exposed to those sectors. So I think we've got one stock down there at the bottom, which is clearly not done quite as well, Eagle Eye Solutions. It's a small cap stock, provides loyalty solutions. It's got a great quality board. Terry Lee is on the board, the former chief executive of Tesco. There's a few ex-Tesco people. Tim Mason is also on the board there, and it provides loyalty solutions provides loyalty mobile solutions for supermarkets, essentially. But that's been a little bit disappointing so far. But I think the key thing that we were looking for across all of these was something where a bunch of stocks where essentially there wasn't going to be where they could outperform regardless of the economic environment. Of course, that's always a very difficult thing to do, but we were looking for these kind of idiosyncratic, I suppose, kind of opportunities. So you can see in there, Serco is another one. Does Serco get hurt if the economy goes into recession? There are stocks that are going to get hurt a lot more because A, it's the start of a turnaround. B, its revenues are all public sector, and C, it's kind of slowly beginning to kind of improve margins after a terrible period in 2014 and 2015. So those turnaround opportunities, Aggreko has a component of that, and one or two of the other ones have that kind of element to them as well. So I suppose in summary, what I'd say is that first of all, there's certainly the potential for the second half of the year to look a lot better than the first. There are big risks. That scenario we've already covered. Currency devaluations, beggar thy neighbour type policies. We've also got subjective interest rates, which are an ongoing discussion. Also some wage pressures building, which as sales start to expand, you could have a scenario where wage price growth actually prevents companies from expanding margins. And so there is a risk there as well, I think. And finally, what I just say is that investing is not supposed to be easy, but it is generally, almost all the time, extremely interesting. What we're trying to do, at Shares Magazine, me and the team, is really to try and provide you with the tools and the information that you need to make informed investment decisions. Thank you.
Any questions? Oh, I've got some. That portfolio is our picks from the beginning of the year. We don't sell any of them. They run through for the year, don't they, Will? Whereas we have other portfolios, the plays of the week, where we are more proactive, where we buy, we buy more, we sell, we take profit.
So I think we can trade in and out of these technically. So we could look at one of the stocks and say we're just going to take the profit on that because we think it's gone as far as it's going to go. For an Aggreko, for example. At the same time, what we did do this year and what we also did last year is we normally run these idea kind of lists with a stop loss. So as soon as the stock goes down 20%, it's out, and it stops out at 20, at minus 20. We thought it was a bit unfair on our readers who were trying to track the progress of the ideas, because sometimes the stock can really just plunge much further than 20% lower on a trading update, for example. So it wouldn't have been necessarily a fair representation. So last year, where we beat the market by in the region of 10%, and this year, what we've tried to do is run without any stop losses. And yes, you are right. These are supposed to be ideas for 2016. They're not ideas for the first quarter of 2016. So what we've been encouraging everybody to do is to take that time frame in mind, and as far as possible avoid taking a profit or taking a loss during the course of the year.
I'm putting you on the spot. As a team, or your own individual opinion, do you think the FTSE is going to be higher or lower at the end of the year from where we are now?
I've really got
what's crystal ball
absolutely
saying?
no idea, I'm afraid. Of course, there's no way I can say that. I think what I've said is that what we've had for the last year is a market where you've got there is actually a lot of action at the kind of lower end with consumer-related stocks have had a really good run. You've kind of seen some of the alternative financial stocks doing extremely well. But energy has held the market back. So when you look at the FTSE All-Share or the FTSE 100, it's down, kind of 9-10% in the last 12 months. But underneath that, there's been a tremendous variation in performance. And I think that's what the sales numbers showed at the start, really, is that the market is kind of going sideways, but there's a huge amount of activity within it. And, stock pickers, I think most of, this audience is an audience which is looking to take proactive positions on stocks. It's actually been a very good period, for us as stock pickers to do a little bit better than the market.
Anybody else got a question? Gentleman there.
How optimistic are you about the oil price going forward?
I think it's very difficult to make calls on individual stocks or commodities. I think long term, oil is a finite resource. But we've got a very odd situation at the moment where we're drilling it out of the ground, and then we're realizing that actually nobody wants to buy it, and we're putting it on boats and sailing it really slowly around the world. I think, what you're doing now, you're starting to see people, we're going to get a situation where people are going to start drilling it out of the ground and then piping into another hole somewhere else so they can drill it out later. It's kind of, there's a lot of inventory of oil flying around the world. And there's evidence that that's starting to move, that some of the inventories are starting to be drawn down. There's a little bit of evidence. I mentioned this kind of the signs of this fiscal stimulus move, which is starting to possibly bring a bit of demand back into the world economy. Countries like Japan have already got aggressive government programs, which is increasing their domestic, the domestic demand in their economy. Canada has just implemented very aggressive fiscal programs. You've got two massive, important countries juicing their economies, and there are calls from a lot of the big economies for them to do that too. And so that can have a tremendous impact on equities and commodity prices, in my view.
I love the idea of being able to find oil and move it into another hole somewhere else. I know some small cap oil companies that seem to do the same at the moment. Discover the same oil 4 or 5 times, sometimes in Cuba and in Gatwick. Anyway, any other questions, anybody else? No? Thank you very much, Will.
No,
Thank you.
you.